Hello. Down here by the local Teddington Lock. I want to talk about Bitcoin and how it kind of like if it's still a revolutionary force that it may once have been. I'm going to say that Bitcoin BTC, actually, the original Bitcoin, the favorite cryptocurrency at the moment, the top dog if you like, is no longer a revolutionary force and probably more of a hampering force at the moment. I actually recorded this video earlier today near the COVID lockdown death wall with all those hearts on the wall by the Thames, but the video cut short without me knowing because I was flicking through my phone that I'm recording on at the moment, and I flicked away from the camera and it stopped recording without me knowing. So I rambled on for about 45 minutes without anything being recorded, so that sucks. Anyway, or at least it wasn't being recorded on my phone. I've got an extra mic here set up. Anyway, so I think it would have been a good video actually, walking along that COVID lockdown wall, if you like, talking about this, because Bitcoin, I think, is probably one of the best tools to kind of combat that type of situation should it arise again, whereby you have sort of lockdown and the government threatening to create a kind of vaccine passport kind of digital ID situation where your every move is traced, and you're forced to live in a smart city, and you can't do anything without having had your 50 jabs, and they can control the population, right? The number of people in the global population, or at least the population in the West, with their vaccines. Put two and two together. Basically, their vaccines are. If that situation should arise where they have that much control over your health, then it's probably not a good thing for a lot of people, at least. Anyway, I'm getting off topic. This is about Bitcoin and how it used to be a financial revolution, no longer is. But before I talk about Bitcoin, I want to talk a bit about the origin of banking, because I think it sets up the argument quite well. So there's this kind of standard story about the origin of banking in, say, medieval Europe, and it basically starts with the how people used to trade in gold coins, and there's a whole problem with that in terms of gold clipping, but basically people had gold stored at home, and if you were very wealthy, then you had a lot of gold stored at home, and so people were looking for places to secure it, so that they weren't at risk of having their house robbed and all their wealth stolen in one go. And so what happened in the end would be that these people would turn to their trusted local goldsmith, who would offer to hold it for them in their own vault, and so they'd drop off their gold with the goldsmith, and he'd put it in the vault, and at the beginning it was literally, the business model was for him to just charge a fee for holding it, and they'd get a receipt in return that would say that he would return the gold on presentation of this receipt. So people, whenever they needed to buy something in their gold coins, they would just come back and present the receipt and get the gold off goldsmith, or at least a portion of it, and go buy whatever they're after. Anyway, after a while, trust grew in this goldsmith, and a lot of people, instead of actually going back to the goldsmith to return their receipt to get the gold and pay for whatever they wanted to buy, they just gave the receipt to whoever wanted it in exchange for goods, right, that they were buying. So they just give their receipt, which was as good as gold, because they could go and return, whoever had the receipt could go to the goldsmith and return the receipt in exchange for the gold. So in a way, that's the beginning of paper money right there. The paper gold that people exchanged in, and people Goldsmith could actually aid this trend by actually giving the customer enough receipts that they could trade in. For example, so if someone gave him £50 of gold, they could ask for 5 receipts of £10 each in gold, so that they had 5 receipts and they could trade in smaller denominations, right? And that was much more convenient and actually really good for the goldsmith. I'll explain why. Because there came a certain point where the goldsmith realised that people weren't coming. Some people, at least, a small number of people, weren't coming back to collect their gold for whatever reason, because they traded their receipt and it was traded to someone else, and it got lost along the way, or whoever it was never bothered actually ever redeeming it for real gold. So the goldsmith had like a permanent supply, or at least a permanent amount of gold in his vault that actually wasn't originally his, and in fact was his if no one was going to redeem it. So it actually serves the interests of the goldsmith to give receipts in smaller denominations should people want to trade in the receipts, because it's more likely that some of those receipts won't ever come back. Anyway, whoever received one of those receipts could withdraw the gold, but at some point, because some of the gold wasn't being redeemed, I guess at one point one of the goldsmiths came up with an idea, and was that he could loan out some of this gold to another customer, since it was never going out anyway, and he could charge a fee for loaning it out to this customer. So in effect, by that very action, it was the beginning of fractional reserve banking. So the goldsmith was fairly confident that no one would ever redeem the gold, or this particular stash of gold that was never redeemed, and so he could loan it out to someone else, and then in effect there'd be 2 receipts out for the same stack of gold, right, in his vaults. And just from that alone, he'd basically created money out of nothing, and he'd created an income out of that money, out of nothing. So he'd get a deposit, not just in the in another receipt, or the original receipt that he'd given out to the guy, a receipt worth the same amount, saying this is worth this much in gold, or actual gold to cover the gold that he loaned out. But not only that would the guy give that back, he'd also give back the interest, right? So he'd give back a certain amount of gold that he owed to the original goldsmith in interest. So there'd be a second deposit on top of the original deposit that wasn't going out. And that's the beginning of fractional reserve banking, and that's the beginning of a bank. Which banks are there, in effect, from what I can see, from what I understand, are basically just there to create debt in the economy, to create debt and charge interest on that debt, and that's basically all they do. So the only risk to the goldsmith in that situation would be that all the people holding the receipts would suddenly come in to reclaim their gold all at the same time, and that would expose, if you like, the fractional reserve system. But that never happened. At least it was very unlikely to happen. And it only happened, very late on in the process, when I guess when these banks really had like a big economy going of all these receipts, or all these notes, all these banknotes flowing around, and for some reason or another, confidence was lost in the system. And that's basically what fractional reserve banking relies on. It relies on confidence that the system is legit, and it is the paper you're trading is backed by real gold. But if you compare it to today, where commercial banks hold no gold at all, and in fact hold a fraction of the actual paper money that they supposedly have on their accounts, they can actually create 80 to 90% of money by loaning out money they don't have. So they hold 10% in reserves of actual supposed money that they have on their books. So yeah, the system today is basically insanely debt ridden. 80% of the money supply is apparently debt. And so when you think about it, if you go to a bank and take a mortgage out to pay for a house, say your house is 300,000, you have your deposit that you worked for God knows how long, say 60,000 deposit to put down on a house, but you loan out the rest from the bank, and basically it looks like, from what I can see, the bank just basically creates that money out of thin air, and you go buy a house with that money. But in the end, you're kind of enslaved to the bank because you have to work for 25 years to pay off that loan. You're basically providing the bank with an income that you get from genuine labor that you work every day or 5 days a week for, and you have no time to do anything else because you're basically working with real time to pay that off. So in a way you're offering the real value for something that actually is based on kind of a big fraud. Basically you're there to maintain confidence in the system by paying into it, and not creating a trend whereby people don't pay or go bankrupt and refuse to pay, and that's a big mess. Then the banks lose the confidence and the economy collapses, right? Anyway, that's where Bitcoin comes in. I think Bitcoin is a great idea in its inception with the white paper, if you've ever read it, which is to kind of basically try to create, in effect, a deflationary system within the inflationary, debt-ridden system that we exist in. So the deflationary system is that there is 21 million coins, hard capped on Bitcoin, that is pretty hard to expand because there'll be all sorts of repercussions if the developers try to do that. And you can actually, or it is possible to audit the supply by downloading the blockchain. I've never done it myself, but apparently you can audit the supply to make sure there are 21 million coins and no one's printed some extra coins. So in a way, Bitcoin should be a massive danger to the whole system. People should be ditching fiat currency en masse, but it doesn't seem to be working out that way. It seems to be, even in a bull market, it seems to go up and down, and even though the price goes higher ultimately, it does seem to be very volatile and inconsistent. So so you have to wonder, how come that is? How come Bitcoin isn't really creating the situation where people can trade in Bitcoin effectively, or at least en masse, and sort of undermine the paper currency system that we live in, the inflation-ridden system. And there, you just have to ask yourself a few questions, like, have you ever transacted in Bitcoin? And when I mean transacted on the actual blockchain itself, that can be verified. Don't trust, verify, right? So you transact in real Bitcoin rather than on an exchange or via some sort of second layer custodial service like apparently Lightning, which is used in Bitcoin to do these fast transactions. If you've actually sent Bitcoin on the actual blockchain as it's meant to be sent, right, it's very, very slow, at least during peak times, and it's quite expensive, and it's very expensive during peak times, especially during kind of bull markets where the price is going up and where you're the most likely to want to move the money around. So why is it so slow? And it's very convenient that it's slow. A lot of people, you hear the argument that actually, Bitcoin can't scale, and by scale it means it can't have like a larger number of people transacting in it, like say Visa, where I don't know how many transactions it is per second, but it's a hell of a lot more than around 7. That is what Bitcoin is allegedly capable of doing at the moment. So yeah, I think the big secret is that Bitcoin can actually accommodate many more people onto its system, right? And there can be many more transactions per second, and maybe even enough to compete with Visa, trading in a hard capped currency, and it can be scaled. Yeah, so that's the argument. And if you look at the different coins that go quicker than Bitcoin and trade quicker than Bitcoin, and don't actually deviate from the original system in the white paper, which is, to say, a proof of work system that is cheap to use and quick, then the only one I could see, by the way, this one's called Bitcoin Cash. Is Bitcoin Cash. And but like cards on the table, I'll be transparent. I have a bunch of Bitcoin Cash myself, so of course I've got a vested interest. Well, not a vested interest, an open interest, a declared interest in the fact that I want the price of Bitcoin Cash to go up. But I think because it, in fact, is the Bitcoin that works properly, that it works as intended, that isn't limited in some way, and limited to the extent that you have to use a sort of custodial service, right, where you're left with the problem of either having a slow inexpensive coin to transact in, or you give it to your goldsmith, as it were, the bank to hold the coin, and you can transact in the paper version of it, like in the olden days, right? And yeah, so I'm rambling a little bit, but basically the point is that if you try actually paying in Bitcoin to sort of like get around this whole debt-ridden society and trade in a system that is actually honest, or at least more honest than the system we have at the moment, and you're left with problems. And the problem being that with Bitcoin, which is the reserve currency, it's very, very difficult to do. Reserve cryptocurrency, sorry. And so you're left with only alternatives. And when you try the alternatives, you find that they do work, and they do work properly, such as Bitcoin Cash. So that's basically what I've got to say, is that the original Bitcoin, for whatever reason, there's a whole dispute over the block size of Bitcoin, and the developers refused to increase the block size, apparently, and increasing the block size would have allowed for more people to go to transact on the blockchain without it getting super expensive and slow, at least to the extent that it has. And that was refused for apparently vested interests. And apparently those vested interests were interests that were aligned with the current financial system. In other words, the system was undermined, the Bitcoin system was undermined, and basically it's just living off its brand. And yeah, that's basically it. So if there was a way around that, it would be for another coin, such as Bitcoin Cash, to become more popular than Bitcoin, and actually just do away with those vested interests, and get people onboarding, as it were, into a different system that undermines the current system, that is a fraud, that basically keeps people enslaved. And so that's where I think the revolution lies, using a deflationary currency that works properly within an inflationary system, so that it's less possible to manipulate it behind the scenes, whether it be via a custodial service where they have paper Bitcoin that they can manipulate, or they can loan it out, or whatever that is they do with the cryptocurrency behind the scenes, when it's all stored on an exchange. So yeah, that's what I've got to say about that. I think in my last video I was a bit better in terms of explaining the case, so I might put some clips in if I can find. I recorded it on a separate audio device as well. Anyway, if you like what I said, please like the video and subscribe, and I'll try and do more of these videos, which which I find interesting. I like to research them and try and write a little script here that I've got, as you can see here, and try and make a video out of it that makes sense. And yeah, so cheers, thanks for watching.